Welcome to Breaking News to Trading Moves. We're looking at some material you shared about a recent guidance update from a major player in healthcare distribution, Cardinal Health. And our goal today is pretty straightforward. We're going to pull out what really matters from this news, show you where the market is finding some strength and, well, where it's facing new pressures.
Right. And it all centers on one key data point from Cardinal Health, ticker CAH. They've raised their earnings projection for fiscal year 2026. And this isn't just a small adjustment. They're now forecasting at least $10 per share.
At least 10. So that's up from their old range of what, 965 to 985?
Exactly. So it's a definite step up. It signals a lot of confidence.
Okay, that's a firm number. It shows they have some real visibility into their future. But let's get right to it. What did management say is actually fueling this higher forecast?
They pointed to two main drivers. And both of them, they point towards some broader changes in the industry. First, they're really leaning on the continued growth in specialty medicines. They now expect specialty revenue to go past $50 billion.
$50 billion. That is a massive number.
It is. It really puts the scale of this growth into perspective. And second, they're seeing growing demand for all the services they can attach to drug development and commercialization.
So it's not just about moving boxes from A to B. It's about high-value products and high-value services. That $50 billion number alone seems to explain the whole thing.
It absolutely does. And we should probably talk about why specialty drugs are so important for distributors. These are not your standard high-volume generic pills.
Right.
Specialty drugs are complex. They often need things like ultra-cool storage, really fast delivery, specialized patient handling. They're high-dollar products for treating tough conditions. Think oncology, autoimmune disorders, things like that.
And because they're so much more complex to handle, the distributors get paid more for it.
Exactly. When you're dealing with products that need careful cold chain logistics, that have a short shelf life, that require super controlled inventory, those services command a premium. So specialty drugs usually offer much higher margins for the distributor compared to the very slim margins on standard drugs.
So a better product mix, more specialty, can boost profitability even if the total number of prescriptions stays flat.
That's the real lever they're pulling, yes.
I gives this news a much broader context then. When a distributor as big as Cardinal Health raises its guidance like this, it suggests a healthier environment for the whole pharma supply chain. We're talking about better pricing, a better mix of products, and more services being sold across the board.
And we can't ignore the regulatory piece here, which was also mentioned. Clarity is everything, especially with these high-cost products. Cardinal Health gave an update on how they're navigating the new Medicare drug price negotiation era.
Ah, right. That's been a big question mark for the sector.
It has. And while those negotiations are meant to lower costs, the distribution system needs, clear and reliable economics to work. So this update helps define how things will work for branded drugs, and that just reduces some of the financial uncertainty that's been hanging over everyone.
Okay, so management's confidence is up because the path forward seems clearer and more profitable. That sets the stage perfectly. Let's start identifying who benefits. Let's talk about the market winners when distribution and specialty medicines are growing this strongly.
Well, the most direct read-through is for the other distributors. Cardinal Health's strength just reinforces the idea that, scale, a good specialty drug mix, and service fees, that's the recipe for strong earnings in this sector. They're all playing the same game, and it looks like the game just got more profitable.
So if you're looking at that group beyond Cardinal Health, CAH, you have to look at their peers. That means McKesson, ticker M-CK, and Cencora, ticker COR. They all have similar models and benefit from the same trends.
Absolutely. Then if we move beyond the wholesalers, the next clear set of winners would be the specialized partners, the ones who actually make sure these complex drugs get to the patient safely. We're talking specialty pharmacy, infusion providers, and at-home care services.
Right. This group is critical because, like you said, these aren't simple products. You can't just drop a complex refrigerated biologic in the mail and hope for the best.
You can't. So more specialty drug volume means more demand for these partners. They handle all the tough stuff, navigating prior authorizations, managing strict cold chain logistics, even administering the infusion, and then providing ongoing patient support. These services are non-negotiable.
So that points to companies like Option Care Health, which is OPCH. They specialize in infusion services, and maybe Baxter International, BAX, for their technologies that support complex clinical products.
That's a solid list. But let's not forget the second driver Cardinal Health mentioned, the growth in services that are attached to care delivery. It's not just about logistics. It's also about managing the provider's workflow. They specifically mentioned expanding their management services organizations, MSOs, even in areas like urology.
MSOs. Some of our listeners will know that term, but for those who don't, why is MSO expansion a growth driver? How do they add value?
An MSO is basically an outsourced business management team for a doctor's office or clinic. They handle all the headaches: complex billing, contracting with insurers, IT, compliance, all the back office management. This lets the doctors just focus on patient care and, increasing their procedure volume.
I see. So the MSO makes the practice more efficient, which allows the doctors to see more patients and perform more procedures. That's the financial lever.
Precisely. Cardinal Health mentioning this confirms that services wrapped around care delivery is a real growth area, and this benefits the whole outpatient care sector. When they talk about growth in something like a urology MSO, it proves that providing that back office support leads to higher volumes for the clinics.
That makes perfect sense. So companies benefiting there would include Surgery Partners, ticker SGRY. They focus on outpatient surgery centers. And maybe U.S. Physical Therapy, USPH, which manages clinics that also need that kind of efficient support.
The takeaway here for the upside is that the rising complexity of medicine, especially with specialty drugs, creates a need for all these specialized support systems. And that need drives revenue for everyone in that ecosystem, not just the main distributor.
Okay, now for the other side of the equation. There's rarely just a unilateral upside. If Cardinal Health is raising its guidance because of high specialty margins, that money has to come from somewhere. So when specialty drugs are booming, who's feeling that financial pressure? Let's look at the potential losers.
The first group facing that friction is the health insurers, or the payers. For them, specialty drug growth is just a constant cost headwind. These are high-severity claims. They're the ones paying the final bill.
And even with all their tools like managing utilization or getting rebates from manufacturers, the overall cost of these drugs is still climbing fast.
That's the core issue. That persistent specialty inflation, even with those offsets, puts a real strain on their margins. Specifically, it hits their medical loss ratio, the MLR. That's the percentage of premium revenue they spend on claims. If specialty costs keep rising, the MLR creeps up, and that squeezes their profitability.
So the companies managing that risk are the ones under pressure. That would be United Health Group, UNH, Elevance Health, ELV, and the Cigna Group, CI. This trend is pretty much the opposite of what they want to see.
Right. Now, the second category, feeling the squeeze. Pharmacy benefit managers, the PBMs, especially those with a lot of exposure to retail pharmacy. The way these specialty drugs are distributed is changing, and it's not in their favor.
How does this bypass the PBM? I thought their whole job was to manage drug costs.
They do, but the high-touch nature of these drugs means the distribution is moving toward more integrated care models and limited channels. Often the drug manufacturer will say the drug can only go through a specific, closed, specialty pharmacy network.
Which cuts out the big, traditional retail pharmacy chains.
Exactly. And that intensifies the reimbursement pressure on their traditional retail business. Even if their script counts for regular drugs look fine, the most profitable scripts, the specialty ones, are being sent elsewhere. It creates a real reimbursement problem for companies with big retail footprints.
So that makes the list clear. We're talking about CVS Health, CVS, and Walgreens Boots Alliance, WDBA. They're dealing with a distribution model that's actively sending high-margin prescriptions away from their stores.
And finally, let's think about the hospitals and large provider systems. They are obviously needed to administer a lot of these treatments, but they face their own internal strain from this trend.
How does a high-cost drug strain a hospital? I mean, they get reimbursed for it eventually, don't they?
They do, but eventually is the key word. The timing is everything. When specialty drugs become a larger part of the care they provide, the internal process, the buy and bill, gets very complicated. The hospital has to buy this incredibly expensive drug inventory upfront, stock it, administer it, and then wait. Maybe 60 or 90 days, sometimes longer, for the insurance reimbursement to finally arrive.
Wow, that sounds like a major drain on their cash flow.
It's a direct strain on their working capital. Imagine carrying millions of dollars of expensive inventory on your balance sheet for months before you get paid for it. It creates margin volatility and just puts this constant pressure on the hospital's cash flow.
So even though they're providing the care, the financial logistics are brutal. The material points to systems like HCA Healthcare, ticker HDA, and Tenet Healthcare, THC, as examples of large organizations facing this.
Yes, they are dealing with that buy and bill complexity at a massive scale. It's a tough spot where more demand for care is good for volume, but the financing needed to support that care is a constant pressure on their liquidity.
So let's quickly summarize the two narratives here. On one side, you have strength in distribution and specialized services. On the other, you've got increasing financial pressure on payers and the traditional retail channels. For someone watching the market, what's the immediate traded context?
The material suggests a pretty clear read-through for these peer groups. If the strength we've seen in Cardinal Health CAH holds up, if the market buys this as a true industry trend, then you would watch for similar moves in McKesson, MCK, and Cencora COR. They're all tied together by these dynamics.
And on the flip side, if the story about rising specialty costs really starts to weigh on the insurers, we'd watch the performance of United Health Group, UNH, Elevance Health, ELV, and Cigna CI. If they start to underperform the rest of the healthcare service sector, that's often a sign that investors are pricing in that cost headwind.
And this whole dynamic presents a broader question for you to think about as you watch the healthcare market. If treatments keep getting more complex and more expensive, will that just demand more specialized third-party services, creating more friction points in the system? Or will integration eventually smooth out those costs?
A lot to process there as the healthcare market continues to evolve. Thank you for walking us through all of this.
Of course. And we must include this required statement. This discussion is based purely on the information provided in the material shared. This is not financial advice or a recommendation to buy or sell any security. This is purely the opinion of the author of the material reviewed.
We'll see you next time on Breaking News to Trading Moves.